Hey everybody. I don't know what happened to the other stream, but I'm gonna move over here. Hopefully people find this. And not really sure what happened there. I'm gonna see if I can redirect people from that one to here. So sorry for that, but as I see people join, I will feel confident that we made it over here. So just give me a sec to direct people into a new place. All right. So, bring the studio up here. Mhm. Got lives and redirection to a new one. All right. Thanks, Anas. Nice to see you. Great to see that you've booked an appointment. That's fantastic. Just gonna wait for hopefully anybody that was waiting on the other one to come over here. I don't know what happened with the schedule, but it didn't seem to work to go live on that one for some reason. So I'll have to figure that bit out on the next live. So hopefully I didn't lose too many people, but we will record this and post it as well. So everyone's questions will be answered, and I'm going to pull those questions up right now. So yeah, I got quite a list of questions this past week or past few weeks, I guess, since I did my last live video, and I thought I'd accumulate those here and be able to answer a bunch of questions for everybody. We do get a ton of questions onto our website and people reaching out. Sometimes that turns into what a paid consultation. Sometimes it's new clients, but sometimes people do just have one-off questions. And what I like to do is either answer those in a blog or a guide or something like that. But there's also, I think, some value in just these one-off questions being able to be answered in a video format. So that other people in the future that have the same question can go back into our YouTube archives and find that question here. So that's what this Q&A session is all about. I'm going to be trying to do these a little more often than almost never, which has been the last few weeks. But I've got some questions here. I'm going to start just going through those, and I will post them in the chat here based on kind of the way that they've come in to me. So this was from a website reach out um, from the website, and that was um, somebody. Let's see here. Oops, too many characters for that. I am charging in. There we go. So somebody says they were charging USD, and the average conversion rate's 30%. Could I not just skip charging sales tax on the product, instead pay it out of the currency conversion bump? So this one's confusing to me. I don't know what this person was maybe attempting to do, but essentially, if you're charging in USD, you invoice that out in USD or make your prices in USD, and then you would add GST or HST in USD as well. Do the conversion at the year end or whenever you have to file, and that's kind of it. I don't know about the skipping charging sales tax. I don't think you should do that. I think you should be very explicit that you're charging sales tax and bump that on top of whatever your fee is. So I wouldn't do this funky carving it out of your cost or anything like that, or the conversion bump or something like that. Just start. This is your charge. This is the GST or HST charge. This is the total amount owed for the invoice. Wouldn't mess around with anything else on that. So hopefully that answers your question. Next one, this one came from Instagram, and it was, how do I claim taxes on crypto gains? So I had to do some research on this because it is fairly, I mean, as far as accounting and tax goes, a new thing. But it really depends on what you're investing in crypto for. I mean, it's called cryptocurrency. Is it a true currency? The Canadian government says no. It's more of a barter transaction if you're trying to buy or sell things with it, and always converted back to the base home legal currency, which is Canadian dollars. And it really depends on your intent. If your intent is for investment, then it would be a capital gain. So you buy at $1, you sell at 2, your capital gain is $1, and you pay tax on 50% of that gain, so 50 cents, and that just gets added to your income. If you're doing this more frequently and it becomes like a part of your income overall, this could be considered business income and would be taxed at the 100% inclusion rate. So you buy at $1, sell at 2, the whole $1 of gain is taxed as business income throughout the year. So a little bit careful. That's a little bit, I mean, a little bit difficult to determine. It's not a black and white, once you hit this revenue level or anything like that, that this becomes a business income or a capital gain or anything. It's more the intent around it. I liken it kind of to actually a client of mine who's a painter and bought a condo for the intent purpose of flipping it to kind of put a fresh coat of paint on it, do a few repairs, and then flip it a few months later. That would be considered business income because the intent was never to buy it and have rental income, and that's the investment. It's the capital portion of having another income source. The intent was to make a profit off of buying it at one price, improving it, and selling it. And so that would be considered a business income. So hopefully that gives you something to lean on a little bit when doing figuring that out for yourself. Next question was retained earnings. Can you explain it? Yes, I can. So retained earnings is really the sort of culmination of all the profits and losses that you've created in your company since the dawn of time. So each year we have an income statement and we close the books at the end of the year. And if you have a profit, we kind of close the books on that income statement, start a new one for the new year, but the profit or loss from that year gets thrown onto the balance sheet as and added to retained earnings, either retained earnings or a retained deficit if you've had losses throughout the years. So it's kind of an indicator of how you've done over the course of your business, but it's also a little bit misleading because it doesn't really talk about the time value of money, or that dollars maybe 10 years ago aren't worth the same as today. So use them with a bit of a grain of salt, because there's a few things that it can affect retained earnings that aren't necessarily completely income and loss. A result of those things, like dividends, for example, will reduce your retained earnings. So you could be profitable, but always be paying out your profit in dividends. Your retained earnings could be zero. So just something there that kind of affects retained earnings. It's not something people really look at as like an evaluation of how the company is done over time. I mean, if there's lots of retained earnings in there, you probably have an asset like cash or something on the other side that just hasn't been paid out in dividends, but it could be an good indicator that you've had lots of profit throughout the years and that you haven't paid anything out in dividends. That's a big thing there. So hopefully that clears up that question. I'll go on to the next one here. The next question was, yeah, it has been a while, Vishri. Sorry for the delay. We've been absolutely slammed up until the end of June. I was kind of hating life because I would come to work in the morning, have my kids, and then come to work in the morning and be just like flat out full meetings all day, and didn't have time to get onto YouTube, and was really disappointed for that. But we're back. I've got some help. So Anas here had mentioned has a meeting with Abhinav tomorrow. So Abhinav is our new senior client manager here at Avalon, and is going to be helping me out with a lot of client management. So really excited for that, to free me up to do more stuff like this and answer questions and be helpful to all you guys. So happy to be back. Thanks for that. All right. So, what are the fiscal and legal obligations, filing requirements to the government for new businesses? This came from Instagram, and I think a long-term follower, a good commenter on our Instagram account. So, really wanted to address this one. And it is like there's so many things to do in the in new business when you're just starting out and you want to make sure that you have signed up for everything that you're supposed to, all your obligations. I do have a list in on our website. We've got avalonaccounting.ca/ more free stuff, and there is a guide here, starting your business guide. So I'll put a link. Oops, I'll put a link into the chat here for anybody that cares to look at it. But there's a guide for starting your business guide, and it kind of outlines all of the things you need to do. And how I sort of think about this um, is one is your municipal obligations. So you start with the small governments. Municipal obligations are number one, so you want to get a business license if you're required to do so in your municipality. Next is provincial. So here in BC we have employer health tax and PST, so you want to register for those things, and also register your name. So you have name registration in your province. And then the next thing you want to do is the federal level. So corporate tax, if you're an incorporated company, you need a business number. Usually a lawyer will help you out getting that. Another one would be to register for program accounts under your CRA account. So that would be, so the corporate one, if you're a corporation, payroll, it's an RP account, for if you do have employees. Next one would be GST, HST, which is an RT account under your business number, and all those things. The other one at the provincial level, if you do have employees, is WorkSafe or workers' compensation, depending on the province that you're in. That's another big one. So yeah, think of all the municipal ones, the provincial ones, and the federal ones that you need to register for. There is, like I said, in that guide, I do have the list there of all the things you need to sign up for, whether you have employees or not. If you do have employees, that's going to be more. And yes, Joel, I do have a question here about the capital dividend account and GRIP. So I can talk a little bit about GRIP. I'm not a tax expert, so I'll give you my my basic understanding of what GRIP is. And I think it covers most people's what they would need to understand about what GRIP balance is. General rate income pool. That's what it stands for. We'll get into that. Thanks for that, Mrs. and Mr. Razdan. Nice to hear the content's been good. And you have a question here about how does the tax thing work if I use my corporation for investing securities? Actually, it's one thing I have to say I'm not super versed in, is using a corporation for investment purposes solely. Holding companies, of course, if you want to use your operating company, transfer money to a holding company and invest there without getting into personal income tax rates. That's one sort of tax structuring methodology. But as far as just like straight up opening a corporation for investment purposes and investing through there, I have to say I'm not super versed at that. I don't know that sort of detail of the tax code and what the benefits and drawbacks would be. So I'm sorry, I can't give you like a full on answer for that. And you could reach out to an accountant with more experience in that. So sorry for that. Let's see here. I do have another question that came to me beforehand. So I'll cover that before I get into GRIP and capital dividends. All right. So somebody says here, let's see. Should filter these out, but I'm just going for it today. All right. So somebody said, can I incorporate my business if I plan on keeping my business entirely online with digital products? And absolutely you can. I mean, So many e-commerce companies are doing that. If you are based in, you have a head office here in Canada, you're a tax resident, you incorporate your company, and it's all online. Absolutely no worries to do that. And um, and it's a benefit too. I think there's legal reasons you might want to do that if you have an online company with digital products, for legal liability and things like that. Speak to a lawyer, but definitely good to incorporate if you are doing that. All good. So I will get into capital dividends a little bit. Again, not a super tax expert here you're talking to. I am a CPA, but I aired more towards the audit side of financial management than tax itself, but I do have a decent understanding of tax as well. So capital dividends and GRIP I'll cover. So capital dividends, somebody, I think there was another Instagram question. Capital dividends are when your corporation gets a capital gain, so buys maybe some investments at one price, sells it at a gain a few years later. Now they have a capital gain within the company. So if you know capital gains tax, capital gains are only taxed at a 50% inclusion rate. So if you have $100 in capital gains, only $50 of that is taxed. But what about the other $50 in your corporation? Like, what happens to it after it's, not taxed? It gets added to what's called a capital dividend account and can be um, dividended out to the shareholders tax free. So people love these capital dividend accounts, but it is really a flow through of something that is not taxable in the first place. But definitely want to make sure that those are flowing out to the owners as you have them. Again, there's some tax planning stuff that I'm not super versed with. We do tend to hire tax experts when transactional things like this come up in our business. But that is sort of essentially what capital dividends are. The next is GRIP, and this is another sort of tax account that you have. Sort of your accountant will keep track of and report to CRA, and it stands for the General Rate Income Pool. And I think this kind of goes back to a misconception that I've been trying to, hammer into people, is that, people think that dividends are taxed at a lower rate, and to some extent they are. But what you have to understand about the Canadian tax system is that the corporation has already paid tax on that income. They're just letting the dividend flow through to the owner, and the owner paying the rest of the tax at their marginal personal tax rate. So they think it's a lower tax bill, but their corporation has already paid some of that tax. With the GRIP, and most of the companies that we work with, I'll say, get the small business deduction, which is if you're a Canadian controlled private corporation making less than $500,000 in profit per year, you get a small business deduction, which in BC ends up being an 11% tax rate. So pretty good tax rate for small businesses. Larger companies, publicly traded companies, that they get taxed at the general rate. So they don't get that small business deduction, they get the general rate. So they pay a higher corporate tax rate. What that means is when it flows through to the owner of that company that paid that higher corporate tax, they actually get a bigger dividend tax credit. So they pay less at the personal tax level because the corporation's already paid a big chunk of that tax. They get a better dividend tax credit. And in a lot of small companies, if you say make more than $500,000 in a year, you'll still get some of that small business deduction, but then you'll have a general rate uh, pool of income that's been taxed at a higher rate. So after tax income, and you can dividend that out with that higher dividend tax credit, which is a benefit to the owner. Obviously, you want that bigger dividend tax credit, but it still bears mentioning that the corporation is still paid tax on that amount. They've paid a higher rate of tax in the 20s of percent, like 26% or something like that, depending on the province that you're in. But that's where you get this general rate income pool, and companies really like these, so they can pay out the owners and they get the bigger dividend tax credit. I hope that makes sense. I mean, I could maybe explain it from a different angle or something, but I hope that covers your your question there, Joel. You asked me to touch on it, maybe not get into too much detail, but hopefully that was not too detailed. It gives you a good understanding. All right. So if I incorporate this next question here was, if I incorporate, what kind of revenue threshold should I be considering before I pull the trigger? So there's a number of ways to think about this. And I do have a video on the channel about it, which covers it in detail. But people do like to have that number, that trigger, where it says, okay, once I make this amount, um, I am going to incorporate my business. And I think that's a part of it. Absolutely. There's a part that, there is an income level where incorporation makes sense. But I think the first thing you got to think about is like, what's your intent with the company over the long term? If you're trying to grow a company, it may pay before you haven't even have any revenue, because you might be sort of triggering a low um, purchase of your shares, so you can get more lifetime capital gains exemption when you eventually sell the shares of that company. So you maybe buy your shares for $1, sell for 900,000, and all of that money is tax free if you incorporate early. So that's one reason why maybe it doesn't like fall into a number category. But then I see other people, they're just making a good living, and they're like, okay, does it make sense to incorporate now? I've been running as a sole proprietor, making $150,000 a year, and is it time to incorporate? And what I usually say about that is, if you make more money than you really are wanting to spend personally, and your RRSPs are full, and people argue with that aspect of tax planning and things, but I think for most people, it's keeping it simple. Is that, the number one way to um, save on tax is to put that money into RSPs. It is the cheapest, most efficient. You retain 100% of your capital, and you don't have to create a corporation or anything. So you're making your money and you just stuff full your RSP. But there's limits to that. So I think the income limit really is like 156,000, where you're going to start running out of RSP room. So if you're making $200,000 and up, and this is a number you hear pretty often about incorporating, then it might be worthwhile getting a second layer of tax sheltering, which is corporate level. So again, like I mentioned, 11% small business tax rate in BC, you can retain 89% of your capital. 100 minus 89, or minus 11 is 89. So 89% of your capital is there. And then you can grow some investments within the corporation, maybe even create a holding company eventually and transfer some money to that. But that's kind of the initial sort of RSP. Then I still have more money than I know what to do with. So corporation. And then once you start reaching, like $50,000 in passive income limit, then you start, needing some more advanced, probably tax planning, which I won't get into, but it's more, you have these levels of tax sheltering. So long answer for what the income threshold. I usually say, if you have more money than you know what to do with, consider incorporating. That's a good one. Oh, awesome. Thanks, Joel. Thanks for that feedback. Hopefully, I'm glad to hear it was at least understandable. Great. Vishri, do you help with closing a business I incorporated, but need to close it as it's conflicting with your new full-time job? Yes. So we have done some help with that. I do. Ooh, do we have the blog post up? I think I have a blog post up now. We've responded to this quite a bit. So go to the website, check out our blog post first, and it kind of shows how we might be able to help with that, or what you may be able to do on your own. But if you have if it's incorporated, um, then yes, so it may be worthwhile hiring us to help you kind of close that down. G Marks, thanks for the question here. Does it make sense to incorporate to own real estate? It's one of those funny things. I think like, again, not an expert in real estate investing or anything like that, tax sheltering for real estate. Essentially, like, you don't get a lot of benefit by running rental income through a corporation because it's considered passive income or investment income. So you get kind of taxed at a higher rate. You don't get that small business deduction, which makes incorporating make a lot of sense. There's probably legal reasons you might want to invest in that real estate through a corporation rather than personally, but I don't know if tax would be the number one reason. And again, like, I just have to say, I'm not like an expert tax planner on the real estate side or investment side. So there's better people um, to answer that question. Sorry, G Marks. I wish I could give you a more detailed answer, but I think there is some misconception that suddenly this, if it's business income, or if you're incorporated, you get taxed at a lower rate for real estate. It's not necessarily true unless that is your business. And real estate businesses have to have like 5 full-time employees. So kind of investment property management company versus just, if you have one or two rental properties and you're running around town and fixing those up and making sure renters are happy. So yeah, something to watch out for there at least. Oh, great. Be sure I'm glad you grabbed that blog post. We're trying to do that, get those out there. All right. I do have another question from our Instagram, which I'll post here. I will get to your question too, Mustafa. Should I get business liability insurance as a sole proprietor with an online business? I absolutely think that insurance for any business is important to get, and especially for sole proprietors, I would say, because you don't have that layer of protection that you do with a corporation. Like, again, corporations like absolutely still get insurance, but especially with sole proprietors, where you might have a home in your name, you might have a car in your name, you have assets that are in your personal name, and if your business is your name as a sole proprietor, which it's the same legal entity, there's no barrier there. So insurance is your best insurance against people on the internet, which if you're an online business, you might find that somebody just takes you to court for what is seemingly no reason. So just something to be really careful of there. All right, Mustafa, what are the tax implications of raising money through series A, B, C, and so on, i.e. selling preferred shares? I don't think there's much tax implication to issuing preferred shares from your corporation. If you're issuing them, people will be purchasing them at a certain dollar amount. Maybe you're raising money through that. You're collecting money. That's investment money. It's sort of, issuing shares and collecting money so that cash goes in your account and you have preferred shares that are outstanding, and they kind of look like debt a little bit. Um, so there's no real tax implication to that I can think of at the corporate side. People obviously, people that are, buying those preferred shares will want to make sure they record really carefully what they purchase the shares for, so that if they sell the shares later, that they know what their capital gains are or capital losses if the business doesn't turn out. I think that's one of the big ones, is that they know how much money they lost and can apply that with a allowable business investment loss, which is a unique kind of loss where you can apply against other income. Sorry, I hope that answers your question, Mustafa. I can't think of any tax implication to it. So thanks for your question. All right. Are there any? Okay, I'll copy and paste this one so you guys can see it. Next one up was, are there any benefits from a tax perspective to pay myself a salary as opposed to no salary and just paying tax on the total? So I don't know what the total is, but are there any tax benefits to just paying yourself a salary as opposed to no salary? So I can see this in, say, in your first year of business, the companies maybe can't really afford to pay you a salary, and maybe you're putting in your sweat equity into your new business. And there's, it's like, okay, I'm going to treat the business right. I'm not going to take any money out of it. I'm going to keep it going that way. And that can be a real mistake from a tax perspective because things like your personal non-refundable tax credits, they don't carry over year. So you want to have some income included in every year that you exist and to take advantage of pretty much tax-free amounts that you get from the government each year. So it's like $13,000 or something where you pay no tax on. So you want to make sure you actually get some income into your hands in each year. Never like you almost I can't think of a reason you would ever want a $0 income year because you've just wasted some tax-free money. So that is one benefit to always pay yourself some sort of salary or dividend. Um, uh, and then you can even, pay your remittance. There'll be no remittance and just loan the money back to the company afterwards. You've sort of taken the money as income, filed your personal tax return, and you can lend that after tax money back to the company. Um, I'm pretty sure that wouldn't. Well, I'm going to check with an account with your accountant who you've paid before actually doing that if it comes up. But I can't think of a reason that would be an issue, as long as it goes through the proper channels of filing your T4s and whatnot. All right, G Marks. If I give my business a loan, is there a max time limit to pay it back? Say 5, 10 year or more years? No, there's no real limit on that. Not that I know of. I mean, it's after tax dollars, so like the money that you have that you're lending to the company, that's already it's already been paid tax on. So there's no real time limit to pay it back for the company. There are like loss the company's not able to pay that money back over a long enough period of time, your issue is going to be whether you can carry back losses far enough and utilize those losses or carry forward losses. But that's like 20 years. So um, I don't think you really have to worry about that. You'll be able to carry forward losses with the corp. Yeah, I don't think there's any limit to that. I can't see why there would be. It's already tax paid up, so it should be fine. All right, I got another question here from, I think this is from Instagram. There's quite a few of those. Somebody was asking about if I hire virtual assistants to help me in my business, do they count as employees? Would I need payroll, workers' comp, etc.? So kind of a blended answer. So number one is check out our employee versus contractor video and blog post. It's not what everyone thinks it is. Sometimes it's like, oh, I'm hiring a contractor, they're a contractor. I have a contract, so they're a contractor. That's not always how it goes. So make sure you check off that list because you can save yourself a lot of trouble by just setting that relationship up properly from the start, especially if you want a contractor. So if you hire virtual assistants, I think the biggest thing is, do they have other clients? Are you one of their clients? And do they market their services? All those kinds of things. If that's the case, they invoice you, charge you GST, they have a running business on their own, absolutely they'd be considered a contractor. You wouldn't have to worry about that. Would you need payroll for that? No, you wouldn't. You can just pay their invoice. They'll probably charge you GST or HST if they're, established business with more than $30,000 in income in a given year. Or if they're overseas as well, that might be, that's another common scenario. That would be fine. So, but workers' compensation, that's an interesting one. If you're hiring contractors, there is a space, at least in the BC return, where you do have to enter contractor worker payments and pay some workers' comp on that, unless they have their own workers' comp. So you can always ask your virtual assistant whether they have workers' compensation coverage, and to make sure you can exclude that contractor income from your filing, from your workers' comp filing. That's a good question. Yeah, I like that one. Okay, so Brennan C, thanks for your question. Can I have a corp with multiple business types? For example, healthcare professional and as a music educator? If so, how does it work? If not, does that mean they need to be separate corps? Really good question, and we do get this quite a bit. I think a lot of people maybe start out with maybe a product-based company, but they're using some service-based consulting to get the company up and running. And there's no rules against keeping those in the same corporation. Um, I think you'd find lots of businesses have a product side and a service side, and maybe consulting side of their business. So no issue having multiples. I think one of the issues we talk about when people do bring that up early on in the conversation, when they're starting their business, is like, are these truly separate businesses where one might have value to someone to purchase in the future? How are they going to be able to evaluate that company and you be able to sell that company if you've muddied it with some other activities that you do on a personal level? So something to consider there. It's not the craziest thing. I think the other thing would be liability purposes. Is one of the parts of that business inherently risky, and you're putting all your you're putting it all through the corporation, so it may have more cash basis or something, more cash in there, and the risky side of the business would have access to all that cash for maybe the profitable side of the business. So that's just the other side of it. I don't think there's any worry otherwise, and again, lawyers might have another take on that, but that's my evaluation that I've sort of done over the years. And follow up, what's the difference between a corporation doing active business and a holding company from a tax perspective? Actually, there's no legal difference between an active company and a holding company. It's more, holdcos tend to just have investment income in them or investments in them. That's to shelter them or give them some difference from the active business where more risk might lie. So the profits are, the activities of that active corporation, um, is where some risk might be. Like, I don't know, you mess up and somebody gets hurt on your business property or something like that. You don't want them to have access to all those assets that you've created over the years. So that's why we sort of move that up to a holding company. Then there's different income types. So there's active business income, which is really business from active business activities, employing people, equipment working, all of that, versus investment income like a rental property, maybe shares that you have, mutual funds, that kind of thing. So those get taxed at different rates. But you could have a blend of those two things within one active business. It's kind of, that would be a common scenario. But it's more of a designation that we give it as a holding company or an active business. Hopefully that answers your question. All right. I hope I didn't miss any. If I missed one here, feel free to just repost it down at the bottom. Or if you have it, I think we went through the ones that were on Instagram. So yeah, cool. Yeah, that was some really great questions, everybody. Thanks so much for joining today. I'll hang around for a few more minutes here to see if any other questions pop up. But really appreciate your support for the channel. I'll post this so you can refer back to it if you need to. Tell your friends. We're trying to make this more accessible for Canadian entrepreneurs. I have this issue. I didn't really see anything on YouTube, and I love watching YouTube videos to educate myself on other things, and didn't really see anybody doing Canadian business specifically, with the tax questions that come up. And I thought also, we do get a lot of questions from the website from people that aren't necessarily going to hire us, but still like to answer those questions so that we have good videos and whatnot. So keep the questions coming. Email me, throw them on Instagram when you think of them. And we'll do this sort of event more often. And sorry for all the mix up at the beginning of this. I can usually just hit go live. For some reason, it was not working today, so I had to create a different video. But thanks for finding this link and getting on this one. I'll test it a little earlier. I gave myself 20 minutes before this to test it out, and I could not figure it out in those 20 minutes. So I'll try to do better next time. Great. Thanks, guys. Thanks for all that positive feedback. Really appreciate it. Thanks all for joining and listening and all the questions. Hopefully you're out there building a very valuable business here in Canada, and look forward to seeing you on the next one. Cheers, everybody. Take care.